The Get Rich Slow Club podcast is a collaboration between Tash Etchman from Tash Invest and Anna Christina from Perla. The Get Rich Slow Club acknowledges the traditional custodians of the land we record on. From coast to coast, across land, waters, and communities, we pay our respects to elders past, present, and emerging. Any advice is general and does not consider your financial situation, needs, or objectives, so consider whether it's appropriate for you.
Welcome to the Get Rich Slow Club podcast,
where we take you from beginner to confident investor,
where we can teach you everything you need to know about investing.
So come get rich slow with us.
Today we have a super fun episode all about bonds, but today we have Scott from Guideway here to help answer all of our fun questions about it. But before we get into it, let's do our money wins, losses. Anna, do you want to go first?
Yeah, I think I was complaining to you about this before, Tash, but for anyone who came from a different country, such as myself, they might have to do taxes in another country. So the Canadian Revenue Agency, which is the CRA, the equivalent of the ATO.
Scary.
CRA, yeah. IRA.
Revenue
CRA.
Agency.
Yeah, but essentially it's the ATO of Canada, locked me out of the website. So I'm supposed to get money back from the last tax return that I did because I sold my property there, and I can't fill out the information. So they're holding my money hostage because I have to call the CRA, but because they're on the Toronto time zone, which is when we're sleeping, I can't get a hold of anyone, and their customer service is not as good as the ATO here. So I have money mysteriously being held in the CRA, and I don't want to deal with that.
That's not fun. I hate having to go on hold for ages to wait for people to respond to you.
It takes I think one time, because it's long distance too, you're supposed to call a number that's not long distance, but it always ends up being long distance for me. And the last time I was on a call for, I think, an hour and 15 until they picked up. It was so annoying.
Not good.
No, that's
What's yours, Scott? Do you have a funner one for us?
Mine's not so fun. It's probably first a loss, then a win. But my old Electrolux vacuum died last week. So ended up not being able to vacuum for the whole week. So ended up deciding to splurge on a new Dyson. Got the top model.
Yeah. The top one.
Yeah, first time Dyson buyer.
You're not going to regret it.
So really happy about that. So I was vacuuming the whole house, just loving it on the weekend. The most suction I've had in a vacuum.
That's so exciting.
Yeah.
How did you decide?
It's one of those adulting things,
If you know, a Dyson is so good.
Yeah.
I'll never go back to another vacuum.
Yeah, I don't think I will either now.
How did you prioritize, or how did you decide to buy the top model? That's a hard decision.
Well, that wasn't my original intention. My old Electrolux was sort of a compromise when we were looking at Dysons and other brands. And so we ended up getting something that we thought was good, but it was sort of cheaper. This time around, we were like, let's just go for something good, and hopefully it lasts a long time. And I was sort of getting sick of the older one not being able to pull enough. So this one was just, went for it.
I hate when they get a bit older and then the battery starts dying as well, and you can't do the whole house on one charge. That annoyed me with my old one.
Did you have a Dyson as well?
I had an old Shark one, and now I have a Dyson. But now I live in a smaller apartment, so it's easy to do the whole apartment.
Yeah, we have actually two vacuums in our house. We have a Dyson, and I got a hand-me-down Robo vacuum because my friend was moving to San Francisco, and they're like, I can't take this vacuum with me. And that is amazing with little kids, just picking up the crumbs. And so I think once that dies, I'll definitely get a mop one. That's the next thing on the list, finding a good mop situation. I don't know.
That was the thing with this one as well, is it has the wet vacuuming as well. I think it's a new model, but it was on special, so that's why we ended up deciding to splurge for that rather than go for one of the cheaper ones. Is just because it was $500 off or something like that, so you can't not afford it.
You can't not, yeah. They always get you when you go in store and you compare them, or the salesperson is like, but this one does this, and you're like, okay, fine.
Yeah.
Who are you? Can you give us a quick intro and why people should listen to you all about bonds?
Yeah, so I'm Scott Nanfro. I'm a financial advisor. I work for Guideway Wealth. I'm a comprehensive financial advisor, so that means that I can deal with various topics, including bonds, including super, other non-super investments, ETFs, insurances, overall retirement planning. So there's a variety of different topics that I can provide advice on as a financial advisor. And I love it. So
amazing. So good. I'm really impressed because everyone I've met at Guideway seems to have been there for so long. So everyone must love their jobs.
Yeah. I mean, there's a few of us that have stuck around since the early days. I started in 2016. I think the company started early 2010s, maybe 2012 or something like that. So yeah, there's a few of us that have been there since sort of the earlier days. Yeah.
Part of the family.
Yeah, exactly.
And you were at our Melbourne book launch. So that was for people who were there, they know your face.
Yes. They would have seen me there. So that was fun. Thanks for inviting me.
Thanks for coming. This episode was actually prompted by a community question. Someone asked us, I'd be interested in learning about investing in bonds. I currently invest in VAS and VGS using dollar cost averaging. I would like to add in some bonds or fixed interest investments in the next few years to reduce overall risk level. I find few of the Australian finance bloggers speak about holding cash or bonds, perhaps because most are in their 20s or 30s. Thoughts?
Yes. So bonds are one of those things that are much more complicated than they sound. There's a simple way to explain them and then a much more complicated way. So to put it simply, all they are really is just loans. So loans to companies, loans to governments, and the borrower will pay the lender a fixed rate of interest. That's why sometimes they're also called fixed interest investments. And they do tend to be what we would call a defensive asset class. So they're somewhere, in terms of risk, they're somewhere in between the low risk of cash and the higher risk of shares and property. So they're somewhere in between, but we tend to lump them together with cash in defensive investment asset classes. It is really important to note, though, that bonds aren't just a direct replacement for cash. So they might sound very conservative and defensive, and we do sort of frame them that way usually, but they can go up and down in value similarly to how stocks do, because they can be bought and sold on the market, which means they can go up and down in value. Usually that's in relation to interest rate movements. So when interest rates rise, the value of bonds tend to fall and vice versa.
Interesting. And there are different risk levels with them as well. Like not all bonds are equal. It depends where the bond is actually coming from and where you're borrowing money from. Like I've heard people use the example of you can borrow from the US government, you'll hopefully get that back. But if you're borrowing from a random startup company, probably not.
That's right. So just like how you have a credit rating as an individual when you go to the bank to ask for a mortgage, different companies and different governments have different credit ratings as well. So for example, if you lend money to the Australian government or the US government, that's going to be considered a very low risk investment. They have a high credit rating. The likelihood that they're going to default on that loan is very low. So it would be considered a very conservative investment. But the returns also tend to be lower as well. So the interest that they'll pay on that loan is lower because they're a lower risk borrower. But for example, you can also get bond or buy bonds in companies like the big banks or other companies on the stock market, for example, which might have varying levels of risk associated with them. So the big banks are going to tend to be lower risk borrowers, but something like an energy company or something like that might be a higher risk borrower. And also, if you're looking at things like emerging markets economies, they might have bonds that they issue as well. So Brazil, China, other emerging markets that have that issue bonds as well, they're gonna tend to have higher interest rates, so a higher return, but the likelihood that they're going to default on that debt is also higher. So it's a much higher risk.
You just said that when interest rates go up, bonds go down. Is that true?
That's correct. So the reason for that is, so this is where bonds start to become more complicated. So when interest rates go up, all of the existing bonds that have been issued become less attractive for people that are looking to buy those bonds because they can be bought and sold on the market like a stock. Because why would someone go out and buy that bond with a lower interest rate when they can buy a new bond that's being issued with a higher interest rate?
Or you can put money in a savings account that's got 5.5% at the moment.
Yeah, exactly right. So think about it this way, like, maybe 5 years ago, there would have been a lot of bonds that had sort of 1% or 2% interest rates because interest rates were just so low. And maybe they were 5 or 10-year bonds or something like that. So they're still in circulation now. But now people can go out and buy new bonds, or there are bonds available that have much higher interest rates, and they might be ranging from 5 to 7% or something like that. Or, as you said, you can invest in a savings account with potentially a higher interest rate at the moment as well.
So why would someone want to buy a bond?
So the way that we look at bonds tends to be as that mid-risk level investment. So somewhere between cash and shares and property, as I said earlier. But from my perspective, I do tend to look at bonds as more of a medium to longer term investment. So I wouldn't typically recommend that someone invest in bonds as a replacement for cash. So if you're saving up for your next holiday or something like that, you wouldn't use bonds instead of cash typically for something like that. But if you are investing in a long-term investment portfolio, say you're investing for retirement or a goal somewhere longer down the track, then bonds on average are likely to generate a greater return than cash, but at a little bit of a higher risk, and with the added volatility that comes with bonds over cash instead.
So if we think interest rates, so this is a bit of a trying to think into the future, maybe a non-advice one, but if you think interest rates are going to go down, is that a good time to buy bonds then? Is that when you'd be trying to be a bit more strategic about it?
Potentially, yeah. I mean, now is a better time to buy bonds than a couple of years ago. Bonds went through a big decline over the last few years. As you know, if you've looked at the returns on bond ETFs, for example, you may have seen that already. Like if you look at, say, I think around the end of 2020, a lot of the bond ETFs started to decline in value. They were still generating interest and paying out interest payments, but the actual value of those bonds and the ETFs that buy them declined over time during that period. And that's because the sentiment was that interest rate, or the RBA and the other central banks around the world, were going to start increasing interest rates. So people started selling bonds to reposition their portfolio. And it did vary between different markets and types of bonds, but on average, there was sort of around 10 to 20% losses in value during that time. So that would be considered quite a big decline in your investment, something that you might expect more from shares. So it's just that's why, as I said before, it is really important to consider your investment time frame and whether you're actually investing for the long term or whether you're just trying to save and invest for the short term.
Yeah, I think that's why I haven't been that interested in them, because my history of investing, like interest rates have been really low, so bonds haven't had a really good return, and now they're not doing that well or haven't been doing well in comparison to shares. So I feel like for a lot of people my age, it's like bonds just haven't looked attractive at all for the last 5 years.
Yeah, definitely. They went through a really rough period, I think, because interest rates have been were so low for so long, since the global financial crisis all the way up till a couple of years ago when after COVID hit. So bonds weren't paying high interest rates, and you weren't likely to get a high long-term capital growth return on them either. So it just felt like, what is the point, right? When like the bang for buck that you get in an investment like that might not have been very attractive. They're certainly more attractive now than they were, but you've still really got to consider why you're investing and what your goals are, what your time frame is. All of those sorts of things.
I also find here in Australia, no one really wants to talk about bonds. Like it's something in North America that I found like everyone kind of talked about, right? Like one of the ideas that I heard quite a bit was you should have a percentage of bonds that's equivalent to your age. So if you're 30%, 40%. And a huge part of that was to reduce any volatility. And perhaps that's also because the rest of the world got hit with the GFC pretty substantially, as opposed to Australia that was less so effective. So it's interesting because like here, I don't think anyone would want to put 40% of their investments into bonds, as has been suggested elsewhere. What are your thoughts on ideas like that where people say, hey, it should be a specific percentage?
Look, I think that's as a financial advisor, I provide personal financial advice to my clients. So typically, I'm not going to be relying on rules of thumb, and that's what that is.
It'd be a bit funny if you're like, well, you're 40, so here's a 40-year-old plan.
Yeah, exactly.
Yeah. So that's what that is, a rule of thumb, right? And rules of thumb, the ones that have stuck around for a long time, a lot of the time there is a good reason that those exist. So I don't think you should necessarily stick to a rule like that, but it is as you approach retirement or the need to access your invested funds, you do need to consider whether you should be reducing the level of risk in your portfolio. That doesn't necessarily mean going, 60-40 or 50-50 or whatever it might be. And your that 40% in the 60-40 portfolio might not necessarily be all bonds either. You might have bonds and cash within that. So it's just going to depend on your situation. So I think you've really got to sort of think more about what your particular goals are and what's right for you, rather than just go off a rule of thumb. But a rule of thumb is better than nothing. So let's be honest about that, I guess. So because when you are approaching retirement, let's say, when you're getting closer and closer to retirement, that portfolio that you had that was all stocks when you were 20 or 30 isn't going to be as appropriate for you at that time. Like if you're age 60 and you're on the brink of retirement, that might not necessarily be an appropriate portfolio.
Yeah, for sure. And it depends how much you have in your bank. Do you have stuff in the offset? Do you have an emergency fund? What are, like you said, what are your goals, right?
Exactly right. Yeah. When you're going to need access to the money. Like if it truly is a long-term investment, bonds are a good alternative to cash as a defensive exposure or a conservative exposure. But yeah, you've really got to think about what your actual goals are. And that's what I look at as a financial advisor. But as an individual investor, you can sort of think about these things too. Yeah.
How does someone actually start transitioning from having all shares to having bonds in the future? If they've been like me, for example, and they've just bought shares for ages, they're getting closer to 60 or something. Do people sell their shares to buy bonds, or do they start just buying new investments as bonds and not buying new shares?
So it depends on your situation. If you are looking at gradually introducing bonds into your portfolio, you might not necessarily want to sell shares to buy bonds. You might just want to actually just start buying bonds as part of your future investments in the portfolio. And then eventually over time, you'll have built up a portion of your portfolio in those bonds. But there could be circumstances where it might be worth selling down shares to buy bonds or other investments to buy bonds. And that might be if you've reassessed your situation, or your situation's changed, or your tolerance to risk has changed. It might be worth actually considering whether you should make a more sudden change in selling down shares or other investments to buy bonds to decrease that level of risk.
Yeah, when you're getting closer to retirement, that is the time where it is worth actually getting advice. Like there's lots of times you're like, oh, maybe it's not worth it, but I think that's definitely a time to go and see someone if you're thinking about selling $300,000 of shares to buy bonds or something.
Exactly right. Yeah. Look, I mean, just to put this into a bit more perspective, I guess, if you're sort of 40 or 50 and you've still got like 10 or 15 or 20 years away from when you're looking at potentially retiring, you might go with that former strategy of just gradually introducing bonds over time. But if you're sort of closer to retirement, maybe you're age 60 or something like that, and you're looking at retiring, but you haven't really repositioned your portfolio yet, and maybe you are quite aggressive in how you're investing, you might take a more abrupt approach to making that shift.
Especially when there's not been a stock market crash and you're like, oh, maybe now is the time to actually switch that up.
Yeah, exactly. And that's the other thing as well is you're going to want to take into account what the market's looking like as well. Because if a recession's just happened and the markets have just crashed, that might not be the optimal time to sell down shares to buy bonds. That's just the reality of the situation. Typically you're going to want to ride out the volatility. So doing that could mean that you're selling investments at a loss at a time like that. So you probably look. I think that especially as you do get closer to retirement, I do think that's a really good time to actually talk to an advisor, because if you're really not sure on the level of risk that you're taking and whether that's actually appropriate, there are ways that we can sort of help you reposition yourself. Yeah.
Some very general advice. Let's say this person is in their 20s. They've bought VAS, so an Australian ETF, and they've bought VGS, so an international ETF, and they're thinking about buying bonds. What would your general advice be about, like, maybe you should consider bonds, or maybe there's other ETFs that you should look at first to diversify your portfolio?
That's a great question. Look, I would say that you could consider bonds, and if you were looking at adding bonds to your portfolio, I would definitely recommend doing that via ETFs. It's not really feasible to buy bonds directly yourself. You need quite large amounts of money to buy individual bonds, and you're just not going to be able to get the level of diversification that you would through an ETF, because an ETF will have, maybe hundreds of different bonds within each portfolio. As to whether you should include it or not as a 20-year-old, that's a different story. It's going to depend on what your goals are. I would think that for someone that's, 20, early in their investment journey, if you're investing for the long term, most people are going to tend to want to be a bit more aggressive and be mostly focused on shares and property type of investments that are targeting longer term growth. But if you have shorter term goals as well, like let's say that you're in your 20s and you're saving for your first home, what you include in your portfolio is probably going to depend on how long you think it's going to take you to save for your first home. If you think you're going to buy sometime in the next 3 to 5 years, that's a relatively short-term time frame. You might be better off just saving in cash, just so you don't have to worry about the volatility and risks associated with shares or bonds. But say that you're looking at doing that more in the next 5 to 10 years, you might do something more like a relatively balanced portfolio, maybe including some shares and bonds as well, just to get a bit of a better return. But everyone's going to be different. You've got to consider your own tolerance to risk in that as well.
All the disclaimers.
Yeah, exactly. Yeah.
And if it was that same person and they were in their 40s, what would your general advice be for that person?
So it could be worth considering adding some bonds to your portfolio, but again, everyone's different. So that's probably going to be more important to look at tolerance to risk, because it's not necessarily wrong, I think, for someone in their 40s to be in a relatively aggressive portfolio with mostly shares. I do think that can still be appropriate, especially if you are investing for retirement. If you're in your early 40s, that's 20 years away. If you're in your late 40s, that's maybe 10 plus years away, depending when you're looking at retiring. So it's still a very long-term time frame. So you don't necessarily need to include bonds if you've got a high tolerance to risk and you're comfortable with the ups and downs of the market. But at the same time, if you do want to start to be a little bit more conservative as you age, it could be worth introducing some bonds into your portfolio. Yeah.
So someone wants to buy bonds. Where do they start? I know you've mentioned Vanguard. Where can someone go and buy these bonds?
Yeah. So as I mentioned earlier, typically the best way to buy bonds, if you're investing outside of super, so you'll probably already have bonds within your super, but let's say that you're not looking at your super, you're looking outside of super. The best way to buy bonds typically would be through ETFs. So you can buy those through your stockbroker, Pearler, other options like that. And some providers that offer those are Vanguard. So Vanguard's obviously a very reputable company, one of the bigger ETF providers. They have a few different bond ETFs that they offer. There's a few others as well. iShares, which is run by BlackRock, another one of those big conglomerate companies based from the US. So they're pretty reputable as well. Operate a lot of big ETFs, which is good. And BetaShares is probably another one as well. They have a few options available. So when you're sort of comparing the different options that are available, you will see that there's a lot of different bond funds available. You can get government bonds, you can get corporate bonds, you can get sometimes I think you can get diversified bond funds as well, which have a mixture of government and corporate bonds. And then there's more niche areas as well that you can usually find. A lot of the time, it's best just to sort of try to stick to the basics. So, more so either diversified or government or corporate bonds, somewhere in that sort of range, especially if you're using it as a defensive asset class within your portfolio. But when you're comparing different ETFs, you're going to want to look at the fees of each ETF, and you can sort of look at similar ETFs with each of those providers. They'll all have comparable ETFs for different types of bonds. You can just compare the fees that they charge. Sometimes it's worth looking at the size of the bond, so how much total money is invested in it as well. So you can find that through their website, just because relatively small ETFs sometimes can be harder to buy and sell.
What's relatively small? How many millions and millions is relatively small?
So if we're talking about less than the sort of tens of millions of range, that's
tens
smaller.
Of millions. Okay.
Yeah, but a lot of the bonds offered by, say, Vanguard, iShares, the ones that I mentioned already, they're pretty big ETF providers, and most of them are sort of in those tens to hundreds of millions of dollars sort of range. So they're usually going to be pretty easy to buy and sell, or as we would sort of say, that they're more liquid than a smaller ETF.
I just had a quick Google while we were talking to see what the options were. There's one called the Vanguard Australian Government Bond Index ETF, so VGBA. It's interesting that you can get Australian government, very specific, and it has a management fee of 0.16% a year, which is more than a lot of the share ETFs. That's quite interesting.
Yeah. So shares are very, very easy to buy and sell for the ETF providers. There is a little bit more work involved in buying bonds, even for the passive index ETFs. So they do tend to be slightly more expensive, but still fairly low if you're looking at the passive index ones. You can get active funds as well that try to buy bonds that they think are going to perform better. But just like when you're looking at that question of active versus passive in terms of stocks or shares, you've got to consider whether it's worth paying the premium of the higher fee for the active investment portfolio. Does that make sense?
So we talked obviously like a lot about bonds. This whole episode is about bonds, but one thing that people should also take note is they might already be invested in bonds based on what ETF they're invested in as well. I know that you mentioned like checking your super, you might have bonds there as well, but a lot of people who do invest in a diversified ETF might hold some bonds as well.
Yeah, like VDHD is 10% bonds and fixed interest. If you own that, you probably have some bonds as well. There's other ones like the Vanguard Diversified Growth one that's got more bonds too, but yeah, definitely be aware of what else you have.
Correct, yeah. So all of the Vanguard diversified ETFs have some bond exposure, and any major industry fund, all of their balanced in growth, even high growth options will tend to have some exposure to bonds as well, depending on the level of risk associated with that option. So a more conservative investment option will have a higher allocation to bonds. A more aggressive or growth-oriented option will have a lower allocation to bonds.
Going back to our listener questions, this person was like, I've got VAS, the Australian one, and VGS, the US ETF. If they're just trying to look for like another addition to their portfolio and they're like, I'm 20, bonds aren't for me, do you have some general advice on what kind of other diversified ETF or kind of asset they could look into for next?
So, I mean, usually the other types of investments that we might look at including in a portfolio might be, say, property, like through real estate investment trusts, which are, there are some ETFs that specifically invest in real estate investment trusts, or REITs for short. Like VAP, for example, is the Vanguard version, but each of those providers will have funds like that as well. Whether that's a good investment to go out and buy now, that's a different story. I'm not necessarily advocating for that now. I'm just saying that's a common one that we might look at. And it's also important to note that VAS and VGS might already include some exposure to REITs as well. So you should keep that in mind when looking at it. When looking at that, sometimes people want to have an increased exposure to REITs. The reason why they might look at doing that is if you're looking at a more income-oriented portfolio, REITs tend to pay quite high income. They are very volatile as well, though. So it's not like buying a residential property and you don't really see the fluctuations in the value of that property. When you buy REITs, it's just like buying stocks. They fluctuate a lot. So it's as high risk, if not more, than shares in some ways. Other options to look at are, infrastructure. Some ETFs offer infrastructure investments. Again, usually there'll be some overlap if you buy infrastructure funds versus the broader indexes, because usually it's listed infrastructure. So, for example, Transurban is a popular infrastructure stock. That's on the ASX 200 and 300 as well. So VAS will include that already. That's just one example.
What about like different countries or sectors, I guess, within shares? Would they look at something like, is it worth including emerging markets or something like that? Or do you think VAS and VGS is like a solid portfolio by itself?
Personally, I think that VAS and VGS is a solid portfolio by itself. But if you wanted to sort of augment that a little bit and add a little bit more higher risk exposure, I guess, VGE or other emerging market ETFs could be something worth considering. You've just got to keep in mind that they're exposed to less developed markets, obviously, considering that they're called emerging markets. So it's going to be countries that do have less regulations, they're less regulated, and can be more volatile based on what's sort of happening at the time in their countries and their economies. So it is considered a higher risk investment, and they do tend to have a higher investment management fee as well, the emerging market ETFs. So worth considering. I wouldn't really allocate a large amount to that within your portfolio though. So I probably wouldn't go more than sort of 5 or 10% in that, even for a relatively growth oriented or
high growth portfolio.
An aggressive investor. I probably wouldn't even allocate more than that to a portfolio like that.
Do you think people are kind of tinkering with their portfolio too much? Like sometimes I see online there's this need to kind of do more. They're like, cool, I've bought these basic ones. Now I want to buy property funds. Now I also want to buy bonds and I want to buy all these other things too. Do you think sometimes we're trying to overcomplicate it a bit too much?
Absolutely. So I'm a strong advocate for simplicity. I think that a lot of people think that you need to be constantly working on your portfolio and making changes in order to make it better. More complicated is not always better. For most people, a very simple portfolio, like even if you're just using one ETF, like one of the diversified ETFs from Vanguard, or if you're using, say, 3 to 5 ETFs with maybe VAS, VGS, maybe you've got 1 or 2 more, that's going to be sufficient for most people. And if you have your own views on what investments you think are going to do really well, you can choose to allocate some amount of your portfolio to those investments as well. But I think you need to take the approach of this is more play money and these are more speculations, because you're not always going to get these things right when you make a choice about what you think is going to perform really well. You could end up picking the next downturn or the next asset that's going to have a downturn. Like
next big scandal.
Yeah, exactly. Like for example, in just before the year 2000, the tech bubble is a great example of this. People might have been buying stocks in Yahoo, AOL, some of those companies that busted during that time. And it might be easy to say, yes, but look at Amazon and Apple and Microsoft. But you've got to keep in mind that for all the winners that you found out of that, there were a lot of losers as well that don't exist anymore. So there's a natural sort of bias towards the ones that did really well as opposed to the ones that didn't. So I guess just to steer back to the question a little bit, I think that simpler is generally better. Yeah,
it goes back to that Fidelity study where they said that inactive accounts or accounts of people who passed away performed better than people who tinkered with their account consistently. Yeah. And it's hard because with investing, we want to do the best. We want to have the best outcomes. We want to have the best returns. But sometimes just like a simple portfolio is literally all you need.
Yeah, correct. Yeah, there's been a lot of studies on this, and one that I really like to point to is, and you can look this up, it's called the SPIVA scorecard. It's run by S&P Industries, and you've probably heard of S&P before because they're the main one of the index companies that indexes the US stock market, for example. You've probably heard of the S&P 500. They do this scorecard that they call the SPIVA scorecard, SPIVA. So if you look that up, you might have even heard some of the statistics that come out of that. But they do this every year, and they find that active fund managers, so professional fund managers, often don't outperform the index fund managers. I think it's something like 80 to 90%. It depends on the specific asset class. Some asset classes active fund managers tend to be able to add more value than in other asset classes. But usually stocks like Australian and US stocks, like big markets like that, active fund managers tend to underperform markets. And of the ones that do outperform, when you look at longer term timeframes, they don't tend to persist that outperformance. So the winners 1 year, if you expand that out to 3 or 5 years, the win rate drops dramatically. I think it's something like somewhere between 2 to 5% of the funds that outperformed in the first year at any given time frame that you look at. It's usually around this statistical level. The funds that outperformed in the first year aren't in that list of outperformers when you expand that out to 5 years.
And then let alone 10 years or 20 years, because we're investing for the long term. Surely if active managers can't outperform, how would I as an individual be able to outperform, right? Like I'd rather just default to an index fund and get the average and not have to worry about picking the best one, right?
Yeah, that's right. Look, I think it is important to, I guess, have some active management in your portfolio in terms of, making decisions about how you invest and asset class allocation, risk levels, things like that. And that's what I help clients look at. So typically I'm not helping a client pick which stocks to buy or anything like that, or try to outperform the market. That's not necessarily what I do. That might be what a stockbroker does. But as a financial advisor, that's not what I tend to do. It's more so just looking at asset allocation, risk levels, goals, and meeting your goals over the long term.
This has been such a good and helpful chat, I think, for so many people. I find bonds a little bit boring to talk about, but thanks for explaining them so well.
No worries.
Do you have anything else to add?
No, that's it.
That was good?
Yeah, that was great.
Yeah.
Okay. Thanks so much for joining us.
Yeah, no worries. It's my pleasure. Thanks for having me.
And you're from Guideway Wealth, if anyone wants to come and chat to you.
Guideway Wealth, yeah. So feel free to reach out. You can look us up. Just Google Guideway Wealth and you'll be able to find our details. I think we have a booking page on our website. So you can book a 15-minute chat with one of us.
I've got a booking link, so I'll try and remember to put that in the show notes, or you can always find that on my Instagram at Tash Invest as well.
Yeah, exactly. So feel free to reach out. And apart from that, thank you.
Amazing.
Awesome, thanks.
Thanks so much for joining us. If you found this episode helpful, please rate us 5 stars, write a review, or share with a friend. If you're new to investing, make sure to listen to our first 10 episodes. Follow us at Get Rich Slow Club or Tash at Tash Invest or me at Ana Cristina.
This show was brought to you by Natasha Etchman, who is an authorized representative 1299881 of Guideway Financial Services, AFSL 420367, and Perla, who is an authorized representative 1281540 of Sanlam Private Wealth, AFSL 337927. Knowledge is power, especially when it comes to investing. So make sure you check out our financial services guides and read the product disclosure statement and target market determination for any investments you're considering. See our show notes for more info.